Morning and welcome to today's Monday morning financially speaking Monday morning money briefing. I'm just going to share my screen so that we can all see this week's presentation and of course what we're all here for. And in the chat as well, I will share with you now the link to ask any questions that you might have. If you are watching this live, you can ask away within that Slido that you should now be able to see in the chat. If, of course, you're watching this at some point later in the week, or if any other questions come to you, you can always get a hold of us at hello@myfinancialfreedomcoach.co.uk, or of course, you can contact any of us, should you wish, on social media as well. You should be able to reach out to us on one of those channels if there is anything further that you have got to ask. And a little bit of sad news to update you on from this end, which is that this will be the last financially speaking in this format. I will be shifting over the market update to my own channel, to Words on Wealth, so you'll be able to find it on YouTube. It may or may not be a live, that is undecided yet, but there'll be a brief hiatus before we are back. But from here at Financial Freedom Coaching, this will be the last Monday morning briefing that we have in this style. But as I say, do make sure that you get me on YouTube to keep up with these updates if you are enjoying them. So you'll find me at Words on Wealth, and I'll make sure to keep updating you as soon as I possibly can. So without further ado, I will jump into financially speaking this morning, because it has certainly been a big week. Now, if this is your first, hello, welcome. And I'm sorry that it will be your last in this format, but we'll hopefully see you again. So for anybody that is new, and for those who have been here, the agenda is exactly this. Firstly, I'll go through one thing I've done this week to get a little bit closer to financial freedom, before breaking it down across the globe into what's happened in the UK, over the pond in the US, taking a look at a read of the week, looking at Europe and the rest of the world as well. So first up, one thing that I have done to get myself a little bit closer to financial freedom, and that you can channel into your plans as well, which is that I've had a look in on my commodity investments to work out what my stop point might be. For anybody that has followed any investing news over the last week, you'll have probably seen that gold and silver have gone haywire. I feel like all I've been talking about for nearly a year is that gold and silver and other precious metals keep hitting all-time highs. That, some may have said, had to come to an end at some point, and last week seemed to be the beginning of that point. Now, what I've done, therefore, is just had a look at my investments. I've not made any dramatic changes. In fact, I've not made any changes. But what I've worked out is what a stop point might be for me. I've not set one on my own investing platform, because I watch my investments relatively frequently. Not all the time. I'm not an everyday type of person, but I do check in about once a week. And what this means is I can keep up to date with some of the more volatile ones, like the commodity investments that I have. So what I did is I took a look at the levels that they're at, and what level would be the level to start selling little bits if it continued to drop. It's quite low for me personally, but it's always worth having that number in mind and just refreshing it if there are dramatic swings. Normally, when you look at past performance, it's always worth holding tight, and panicking at that bottom point is often the worst thing that you can do. I would never, or very, very rarely, advocate selling everything in one go, but rather my stop point sometimes triggers a little bit of a steady trickle. So sometimes it's something that you could have a look at in terms of some investments might require a harder limit, particularly if they're more volatile. And in more volatile times, you might just need to refresh yourself on what those limits were, or what they're going to be updated to, and what you'd be willing to withstand within your overall portfolio. With gold, it's normally relatively stable. This is a bit unusual, but normally you can start to see, if you look back over previous performance, for example, how volatile things are, and therefore what is an acceptable amount to withstand. So if you're looking at, for example, commodity investments this week and having an equal little panic and a bit of a wobble, take a step back, take a look in, take a look at some past and the rest of your portfolio as well, and have a think about what your bottom line might be to start potentially doing some steady selling and moving away if it feels too much emotionally. So on to then the markets, because I've mentioned there already that gold and silver have been pretty manic, but actually markets have looked a little bit differently. So the FTSE 100, the measure of the 100 biggest companies in the UK, finished the week up by 1.37%. It was a very positive week for the FTSE, despite some of the news coming out of the UK, which we'll take a look at in just a second. The S&P 500, measure of the 500 biggest companies in the US, fell by 0.59%. But the Nasdaq had an even worse week, which is the tech-heavy index in the US. It fell by 3.89%. And the Eurostoxx 50, the measure of the 50 biggest companies across the Eurozone, had a relatively positive week and was up by 1.36%. So this is a bit of a mixed bag, and I'll dig into what's been going on and what you can really use to channel this into your investing. You'll probably be looking at your portfolio, and the vast majority of us will have some exposure to those tech-based investments that form a huge part of the Nasdaq, and I've seen a little bit of a wobble last week. So stay calm, stay steady, and do take away from this once again the importance of that geographical diversification. We're seeing really positive results there from the FTSE and the Eurostoxx, whilst the US stock market are looking a little bit trickier last week. And it's pretty much been the case for certainly a fair few decades that this would not have been the norm. It's pretty much been the case that the US and their stock markets have outperformed the UK, Europe, and other regions. And that is starting to shift. And that is why those arguments for having a little bit of it all in your portfolio have almost never been bigger. So taking a look then at what's happened in the UK, where there is some uncertainty over Keir Starmer, the current Prime Minister of the UK, and crucially, whether he's going to maintain position as Prime Minister. There is a little bit of unrest within his party, the Labour Party, after various different parts of the Epstein files released in the US exposed a key aide and diplomat to Keir Starmer, who is named as Mandelson, early in the morning. His appointment in the US was already quite controversial, and the information that has been revealed in the Epstein files is not particularly favourable towards Keir Starmer, who, it has now been revealed, knew about some of the links between Mandelson and Epstein himself. As a result, there are many MPs questioning Starmer's leadership. Multiple ones have turned to journalists in the UK, suggesting that it may well be time for him to step down, and he cannot withstand this level of scrutiny and, for want of a better word, turmoil within this period. This is ahead of some risky things sort of coming up. We've got various different, not general elections, but there's always more going on, but of course global elections as well. So what does all this mean then for you and your investments? Well, it's just once again a flag of political instability. And if we know anything, markets do not like instability. So talk of the potential Prime Minister having to step down, it's just not good for markets. Now, the FTSE 100 did look pretty positive last week. But over the long run, if investors are looking ahead and thinking that this is becoming ever more likely that Keir Starmer may be ousted from his position because of a scandal, it's not great for business confidence or indeed the value of the pound and other UK-based investments. So how can you channel this then into your portfolio? Well, for right now, there's not a lot we can do. All we can do is sit and wait. But one thing we can do is be aware of that volatility that may well kick off. Who knows what's around the corner? Who knows what this week could bring with more files, more releases, and of course, more political scandal. But do just be aware that that could pan out into a little bit of wobbliness within the portfolio. But normally within political turmoil, it passes pretty quickly. On to then the US, where there was some major earnings announcements last week. That's when companies tell us how they've done, how they performed each and every quarter. They tend to get clustered together as earnings reports, and last week was another big cluster of major companies giving their reports. And crucially, what a lot of this is revealed is that there's been huge levels of spending on AI, around an estimated $660 billion to be precise. And this really caused some ripples of worry to surge through the markets, because actually many investors really feared that there could be a lag on this infrastructure investment and a bit of a time gap in how long it will take for AI to really reap its gains for investors. And as a result, big tech shares fell off the back of these earnings announcements and all of this worry. Now, none of us can possibly know what is round the corner. AI is a really, really interesting one because, of course, we're using AI. We're all aware, likely, of what ChatGPT and other AI and chatbots, large language models can do and what they're doing for us in our life. But are we aware of how much they're costing us or what that looks like from a revenue perspective? We might be, but we're probably all still using them without really necessarily paying for them right now. And a bit like how social media had to pivot to more and more paid options, it will likely be the same within AI. However, that can be difficult. It can be tricky to pivot customers and consumers away from a model that they've previously had for free into something that they now have to pay for. And how much can they all pay for it? And therefore, how much is that going to generate in revenues? The quantity that has been pumped into AI from the likes of private equity, also from major companies, also from the likes of governments and other funders is really, really unprecedented. Of course, we saw it back in the dot-com boom in the early noughties when the internet was becoming rather large, but we're talking bigger numbers now. Some of that is to do with inflation, and some of it is just to do with the sheer hype that has taken place around AI. Now, what those investors are starting to think is, okay, but it's been a bit of a period of time now, and we need to start seeing some gains off the back of that. Ultimately, that's what all investors want. They don't want to just pump money into something that is never giving them back a return. So AI does really need to start generating a return. How they do that is the big question mark. And that's really the next shift into the talk around the AI bubble. How is and how can AI generate money? If they're able to do that, of course, then those fears of the bubble may well subside. If it's a bit of a rockier path, which is certainly how it's seeming right now, then we'll probably continue to see these hiccups in the road. So what does this mean then for you and your investments? Well, tech-heavy portfolios may well face bigger bumps in the road than those that have got other sectors in there. But don't be fooled. All sectors in some way, shape or form are trying to prove that they're using AI and likely are using AI in some way. So if you think about, for example, luxury goods, which may feel far removed from tech, it's highly likely that those huge fashion brands are using AI behind the scenes, be it through generating new designs, be it through speeding up various different admin or more junior-based tasks, or indeed be it through future forecasting as well. There's all sorts of different ways in which AI can be integrated into businesses that we don't even think about. It's across the board. So it's not just tech-heavy portfolios, but it's actually all portfolios if AI takes a bit of a dip. But what this really does is it reinforces diversification, because naturally, those companies that are pure AI companies have got an even greater focus and an even bigger target on their back to be producing some form of revenue. Companies like those high fashion companies that are maybe using AI to speed a few things up. Well, if it doesn't work out, then maybe things will slow down temporarily, but they managed before, right? I'm sure they'll find a way again. It really does also focus on firms with clear profitability. It may well pivot the overall environment of investing towards companies that are already generating some sort of profit. But who knows? None of us can quite predict the future. So just watch out for those investing portfolios and make sure that you have got some level of diversification. If I were you, I'd always check in on funds as well. Sometimes the broader ones, the all worlds, can sometimes be deceptive in how much they're exposed to the likes of tech. Same with ESG and other sustainable funds. So make sure there is still a balance and a blend, even if you are using more broadly diversified funds in there as well. So on to then the read of the week, where there was a super interesting opinion piece in the Financial Times, where the title was "Regulators Should Let Me Buy Whatever I Want." This article really critiques UK retail investor restrictions, of which there are quite a few. And what it does is it argues that rules separating retail and professional investors are inconsistent. So just as a recap, retail investors is the likes of you and I, basically, individuals who are seen as not necessarily having higher levels of wealth or higher levels of knowledge or investment. Now, crucially, I said you and I, but actually I fall into a funny little category that straddles the two. Because if I tick certain boxes to say that I do have the relevant qualifications as a financial advisor, that actually I do and have executed a certain amount of trades, and I do and have therefore also carried out trades on behalf of other clients, that means that I tick a certain amount of boxes that can then allow me to access other products. Now, you'd hope that by ticking those boxes, it does mean that I can understand those products. Perhaps I've used them, perhaps I've studied them and therefore taken relevant exams to qualify within them. But it's not always the case. And also, why should I have those special privileges that other people can't necessarily access? Just traps in with those that are perhaps wealthy, already working in professional financial sectors, becoming ever more wealthy. It's a really interesting debate and one that will probably reign on for some time. And it's certainly not one that only exists in the UK. This also exists across Europe, the US, Australia as well, whereby there is divides between what can be shown to retail investors and what can be accessed by retail investors versus what professional and then institutional investors can also use as well. So institutional investors are the big banks, the insurance companies, pension companies that can then tap into, again, ever more complex financial instruments. I'm not too sure where I sit. For me, it's really important that every investor understands what they're investing into. But who's to say that the retail investor who's really invested a lot of time, effort, and energy into researching and educating themselves on investing can't also understand those products that could help their investment portfolio? It's a tough one. But the FCA in the UK is reviewing their categorization of different products, and self-designation as a professional investor does remain possible. So don't be put off by the title, but it's certainly an interesting debate. Probably one that I'll revisit at some point in future with other content, and certainly one that I don't think is a clear-cut answer, but a very interesting read if you are looking at more professional products too. So let's take a look at Europe, where first up, the EU is considering banning maritime services for Russian oil. This is looking again at tightening sanctions, but potentially facing some level of internal resistance based on the levels of oil that do still come in from Russia and support the overall European economy. Now, stricter oil curbs could well raise, again, energy volatility, which, if we're honest, nobody wants. The European Union and the European Central Bank included in that as well. Because what this could do is push inflation back up and also affect the likes of energy stocks and household fuel costs. It's widely unpopular, especially given the battles that have been faced with inflation over the last few years and seemingly now finally more or less under control. So what this could mean with these stricter curbs is that there's a bit of a lagging on personal finances within the European Union. But what does it mean for you and your investments? Well, it could well mean that once again, there's a bit of volatility within the likes of energy stocks and oil prices as well. Depending on the decision that is made around this, there will, of course, then be a more concrete impact on portfolios. So keep an eye on it if you do have heavy exposure to oil, for example, or energy, because it could be one that impacts you more if that's where your portfolio sits. And then the European Central Bank decided to hold their rates at 2%. That's their interest rates, by the way. This is because inflation has eased across the wider Eurozone, and there has been relatively positive and resilient economic growth as well. This is all great news and really led to the boost of the markets in the end of the week. And it was seen as well in various different domestic markets, with the FTSE MIB, so the Italian index being up, the CAC 40, the French market being up, and the DAX as well, the German market, all ending the week on a high. There could be a little bit of caution on further cuts. They may not be quite needed yet, but this is all good news from both an economic and a market perspective, because stable Eurozone rates offer some level of predictability for borrowers as well as investors. What this could also mean is that there's a further boost to the economy as people kind of know what's going on and what's coming and spend accordingly. So this is all great news, really. As investors, if you're looking at your portfolio, particularly if you've got exposure to Europe, then things have looked pretty rosy, and things are certainly moving in the right direction of stability and strength from both an economic and a market perspective. On to then the rest of the world, where first up, gold saw a really volatile week. Silver dropped the most in one day than it ever has done on record, and gold dropped more than it has done in over a decade. This has fueled all sorts of different booms across the globe, but particularly in China, where losses exposed risks from speculation and platform liquidity strains as well. Traders were going haywire, reportedly also at various different conferences across the globe, and really trying to calm the situation within the precious metal market. It's not a day to have been underestimated, but it's not a day that happens very often, which is the good news. It was certainly very dramatic when we saw the almighty falls that gold and silver took. And as I say, there's always winners and losers, with some more exposed than others. What seemed to have triggered it this time was Trump announcing the next Fed chair replacement. The Fed is the central bank in the US, and at the moment it's been a bloke called Jerome Powell in charge, who, it's fair to say, Trump isn't his biggest fan. That's not because he's necessarily done anything wrong, but he's just not done what Trump has asked. And what Trump has asked goes against the vast majority of economic theory and belief. Jerome Powell has held strong with interest rates and gone against what Trump has desired, which is for interest rates to drop. Now, what most of us would understand if interest rates drop is that inflation could well then start to pick up. But Trump, rightly or wrongly, sees interest rates as being higher as a direct correlation with the poor economy. Now, that is generally the case. It is usually a consequence of having slightly higher interest rates. But equally, having high inflation is rarely associated with a boom and happy people. So his logic and his rationale isn't necessarily adding up. Now, the replacement for the Fed that he suggested is seemingly okay. There was all sorts of fears about who it could be and who he would put into the Fed, which is, by the way, supposed to be independent. Now, when the nominee who he suggested was accepted as kind of, this could be all right, what that seemed to do was signal to the markets that actually a period of volatility was ending. And as a result, we saw gold start to drop off a cliff because that safe haven wasn't needed. The dollar strengthened a little bit, the US dollar, and there was probably fears that actually the US's ship could be steered back in the right direction, causing the need for that safe haven to really start to rock. On to then Chile, where another precious metal, copper, is seeing the limelight. Chile's new government plans growth and deficit reduction using copper revenues. A lot of this will focus on the likes of deregulation and sharp spending cuts. Copper comes from different places in the world, but Chile is one of the world's major miners. Copper is needed in lots of tech-based products, from switchboards to semiconductors and chips as well. So as a natural resource, it's become ever more in demand. And this means that countries that do have it scramble for ways to try and produce it in a way that is cost effective, but also quick. And Chile is no exception. And last but not least, in Japan, where lower house elections were taking place. These seemed relatively positive as the week closed out, really giving the stock markets a boost in Japan, as the Prime Minister's party looked set for some sort of majority. This is normally a positive in any country when a house is set to get a majority, because it means they can make change quicker. This is normally seen as potentially something that could cause instability within politics, but actually something that could yield greater results, as we see, therefore, things pass through the government and parliament much, much quicker. Japan has really come out of the back seats, if you like, over the last few years. They had a tough few decades, and now their economy and their markets are back to roaring. And this is certainly one that many investors are watching. Some may have exposure to it in their portfolios, whilst others may not, because it kind of falls into a funny little area of being a developed nation, but often not appearing in many developed nation funds, kind of falls into its own category. But it's certainly one to watch if you are looking to broaden your global horizons or look for greater diversification. So I'll move now into the Q&A here on the live session. If anybody does have any questions, please do feel free to drop them into that chat bot there that I've got. And as I say, if you are watching this recorded afterwards, you can ask any questions that you have to us either on social media or on our email address at hello@myfinancialfreedomcoach. So you were looking for FTSE 100, but there are so many ETFs labeled with this name. How to navigate this? Yeah, that is a great question. So there are many, many ETFs that all follow the FTSE 100. The key thing to note is that they slightly differ in the way in which they follow the FTSE 100. Now, when you're looking at FTSE 100 ETFs, there'll be different providers. They'll have different company names, for example. Some might be slightly cheaper, some might be slightly more expensive. You might want to find a nice happy middle ground. You can also see how big the funds are, for example, normally in the fact sheet, and therefore how popular they are. This can help to distinguish different ones. You might also be able to try and look at those different funds and see whether they distribute their income, or whether they so whether you receive the dividends that they give out, or whether they automatically reinvest them for you. That will have a huge impact on your overall strategy and also what it looks like from a tax perspective. So make sure that you have a quick look for that. Now, the last thing to note within ETFs is that there are some different ways of tracking. So some will track really, really closely. So if you imagine the value of the FTSE 100 is changing all the time, and some ETFs will seek to do this, whilst others will take a more laid back approach. And generally, if they're seeking to replicate it at all times, it will be a bit more expensive. Normally, if it's more laid back, it's a bit cheaper. For the vast majority of retail investors, being a bit more laid back and a bit cheaper, there is no problem at all. So that's some good starting points to compare some different FTSE 100 ETFs. I'm just going to post the link as well in the chat as requested to the YouTube channel if you do want to find that. And then with the question for copper, you see ETFs and ETCs, what is the difference? Yeah, great question there. So an ETF is exchange traded fund. And this is normally a basket of stocks or sometimes bonds as well. Now, an ETC stands for exchange traded commodity. Copper, gold, silver are examples of commodities. So an ETC is just simply tracking a commodity rather than stocks, bonds, or sometimes other assets. But more often than not, with an ETF, it'll be stocks or bonds. So it's just a slightly different terminology. Sometimes in certain platforms, you need to undertake one of those questionnaires that sees that your understanding of an ETC is high enough to be able to invest into it, because they are seen as more volatile than the vast majority of ETFs. Because within an ETF, you've normally got a big basket of investments. With an ETC tracking copper, you're tracking one thing. So it is slightly higher risk than a whole basket of investments as you get within an ETF, for example. So you can see why you might need to fill out a form, as it relates quite nicely to what we spoke about this morning within those professional investor barriers. Sometimes an ETC can fall into this. So that is the key difference between those two. So hopefully there I've answered all the questions. Thank you so much for coming along and asking away. Hopefully that has been useful. And of course, it's always been a pleasure to see you here. As I say, I'll be picking this back up again. You'll be able to find me on YouTube. I've just shared that there. And we'll be doing other things as well within the FFC community. So keep an eye on your emails, because we'll be making sure that we continue to update you and find something else exciting that will replace these as well. So keep an eye out. Thank you very much. Have a lovely Monday and a great week, and bye for now.